This will be an introduction to accounting for partnerships. Upon partnership creation, you need to understand this is a legal agreement that you're entering into. So it's important to seek professional advice if you ever want to start a partnership. It is a voluntary association, meaning it's a voluntary agreement between the partners. It does increase the risk to your personal finances, and you may be liable for your other partner's actions. So choose your partners wisely. With partnership accounting for the bookkeeping, there will be a separate capital account for each partner and a separate drawing or withdrawal account for each partner. So you're going from a sole proprietorship where you have one capital account and one drawing account to multiple accounts to track individual partners' accounts. And over the life of the business, you're going to need to allocate net income or loss and gains and losses according to a partnership agreement. So what is that partnership agreement? Well, it requires an agreement between two or more competent people of legal age. It should be in writing, but it doesn't have to be, so be very careful. The courts have upheld handshake partnership agreements. So what are some of the characteristics of a partnership, and how does it differ from a sole proprietorship? It is a voluntary association between two or more. There should be a partnership agreement, and it should be in writing. It has limited life, meaning any change to the structure or the ownership, the partnership will end and a new agreement will have to be entered into. There are unique tax rules. Partnerships, just like sole proprietorships, are not taxed. However, the income is taxed on the individual partner's personal individual tax returns. One of the most important concepts is that of mutual agency. And that relates to unlimited liability also. And there will be co-ownership of property, anything contributed. So let's take a look at these. Starting with co-ownership of property, the assets are jointly owned by all the partners. So if you contribute your asset, actually it could have an associated liability, and that will also be contributed. The concept of mutual agency, this is one of the most important legal concepts because each partner is a legal agent for that business, and that's how the public views you. So to protect the public, the concept of mutual agency formed. The concept of agent will be studied more in a business law class or legal environments of business, but it is important to know at least the basics of what an agent is. It means you can enter into a legal agreement, and the partnership will be held liable for the agreements of individual partners, even if the other partners are not aware of it. As to income taxes, just like a sole proprietorship, partnerships are not taxed. Under the IRS, it's viewed as a flow-through entity. The income flows through the business, the partnership, to the individual partners. The income of the partnership is allocated according to that profit and loss sharing agreement to the partners, and that's how it's taxed. There is a tax return that has to be filed every year. It's a Form 1065, and that allocates the income to the partners through a Schedule K-1. So what is a K-1? Well, if you are an employee, at the end of the year, you're going to receive your W-2 so you can file your taxes. Well, a partner is not an employee. A partner is an owner. So it's just another form to inform the IRS of income so that they will look for it on the individual tax returns. So instead of a W-2, you get a K-1 for your allocation of the income, which you then report on your individual tax return on that 1040. It is important for the accountant to allocate the income correctly so that the capital accounts will be correct and for income tax reporting purposes. And again, the tax return is not a 1040. For a partnership, it's a 1065. It is just an informational return that must be sent into the IRS. But the partnership itself is not taxed, only the owners. So now to review a sole proprietorship, and we'll compare this to a partnership. So as you recall, you closed revenue and expenses to the income summary. There was a withdrawal account, and then there would be one owner's capital. But now you have multiple owner's capital and multiple drawing accounts, but the same closing process applies. So now with a partnership, the way most textbooks are written, it starts you with an amount of money in the income summary that needs to be allocated. So just assume the revenue and expenses is already closed when you get to this chapter. Only now, instead of one capital account, you will have multiple for each partner, and you'll also have multiple drawing accounts. So the income needs to be allocated according to the profit and loss sharing agreement, and it's usually not just an easy 50-50 split. Drawing accounts are also closed, same manner. But the focus, what you will study is how do I allocate the income, and there are many different ways. It'll be according to the partnership agreement. It can be on stated ratios, capital balances, or it can be a combination, services, capital balances, and stated ratios. And that will be viewed in a separate income allocation partnership video.